So today we're going to be looking at risk analysis, and we're going to be using two different methods. The first one is to use the annual report, and the second one is to use some quantitative models to estimate some specific parameters of risks, and probably the most important one is bankruptcy risk. So first, let's look at the annual report. So in front of me, I have the H&M annual report for 2015. Usually speaking, most companies will have quite extensive risk disclosures in their annual reports, both in terms of their business operational risks and also the financial risks that they may face in financing of their operations. So in order to find this, again, usually I'll start with going Control F and just search for risk. And I can see that, let's see, risk has 104, even more hits, so it might be a bit too much. But we can just kind of go downwards and see what we can find. So I can see here we have found a table of contents, and it says risk assessment under internal control, page 66, which to me kind of implies that I should probably jump to page 66 and see what they say about risks on that page. So here I'm on page 66, and I can see the heading risk assessment, and we can see a bit writing about H&M carries out regular risk analysis for both operational and financial risks. That's good. Yada, yada, yada. And we can kind of see a bit more writing. And then I can see a bit more writing here where I can see some page numbers. And they say, for a description of H&M's operational risks, see administration report on pages 75, 76. And for risks within financial reporting, see note 2. Financial risks on page 92, 93. So I know that I'm going to find information about their risks on pages 75, 76 and 92, 93. So if we first go down and look at page 75, so I'm just going to scroll down, see what I can find. So here we have 75, and we have a section called risks and uncertainties, and under this we have another heading called operational risk. So under operational risks, these are the risks that are part of operating in this particular business. So here, for example, we have reputational risk, which is, I guess, about the H&M reputation. We have fashion risk, which is very particular to the fashion industry, and that is more to do with the fact that some, I guess, decisions to source specific types of fashion styles might not be great in the end. We then have weather-related risks, and again, weather-related risks in this particular instance relates to the fact that perhaps you have a very mild winter, so some of their winter coats that are more, I guess, warm are not selling. And then again, we can kind of go through and see different types of risks such as sustainability, negative macroeconomic changes, geopolitical, and so on. And what you need to do when you do a risk analysis is go through each and every section and really understand, maybe summarize it in a much shorter format to try to understand the risk exposure. Underneath, we also have some discussion of some major financial risks. So we have foreign currencies, trade intervention, and taxes. And all these three are quite important in terms of, I guess, their risk exposure financially speaking. Again, this is part of the administration report, so this is not technically part of the financial report, which is later on page, I think, 92, 93. So they have risk disclosures in two sections, and this is probably to do more so with their operational end. Whereas if you look at the financial report, and specifically in the notes, you'll see a lot more risks related to, I guess, issues that are required to be disclosed by IFRS in this particular instance. So again, the next page number they mentioned was, I think, 92, 93. So again, I'm just going to scroll down, look through a bit, and try to go down to page 92. And if I go down to 92, we have note number 2, and it's called financial risks. So these are the risks from a financial point of view that need to be disclosed according to the accounting standards, and that's why you find them basically in two sections of the annual report. So here we see, again, interest risk, we have currency risks, but we do see that there's a whole lot more information. So if you wanted to get more information about financial risks, it's probably better to find it here. And again, we go down, we see credit risk, liquidity risk, and so on. And again, there might not be that much interesting information, but you do need to go through each and every heading to understand what is it that they're talking about. Now, in H&M's case, I would see probably the currency risk is probably the most important one because they do sell quite a lot in different currencies. So any fluctuations is going to expose them to currency risk. And as you see, currency risk basically takes up probably half the section of financial risks. So you just really need to understand what about currency exposure is it that makes it a bit risky. So again, it's really about reading and understanding. We do see, I guess, a bit of a section about credit risk, but usually speaking, when we're looking at, I guess, trying to analyze a company's credit risk or bankruptcy risk, it's not something that's going to be very explicitly disclosed in the annual report, and that is why we might need to use I guess, a quantitative model by using Excel, which we're going to be doing in the next step. All right, so in part 2, what we're going to be doing is we're going to be calculating a few different quantitative models that allow us to understand the risk exposure of H&M. Now, the one we're going to be focusing on quite a lot is the Altman Z-score model, which is the one that we use to predict bankruptcy. And again, this is the one that we would have discussed in the first session of this week, and it's probably the most popular bankruptcy prediction model out there. You'll see that we have a few different sections here. We have model inputs at the very top of the sheet. We have Altman Z-score model for manufacturing firms and a modified Altman model for non-manufacturing firms at the bottom. So what you'll see here is that first you have the inputs, which are essentially just the accounts. We have current assets, total assets, current liabilities, and we have the numbers for each and every year. Effectively, what I've done is I've essentially just gone and found balance sheet D20 to essentially reference the current assets in 2011 for H&M, dragged it to the right, and done it the same for all of these. The only one that you wouldn't be able to do it on your own is the market value of equity, which I hadn't downloaded, I guess, in the first week. So to get the market value of equity, what I did is I went to Bloomberg, went to the FA function, and under key stats there's a section for market capitalization. So you just take that line item for those particular years, and that's going to give you the market value of the company. So market value of equity and market capitalization are exactly the same thing. So by using all these inputs up here, we can effectively use this model. So you see that in cell B14, we have the exact formula for the original model, which says that Z is equal to 1.2 multiplied by X1, and X1 is effectively just your current assets minus current liabilities divided by total assets. Then you have X2, retained earnings divided by total assets, and so on. So effectively what we're going to be doing here is we're going to be calculating these ratios for each particular year. And to get the final Z-score, what we need to do is we need to multiply 1.2 multiplied by the value of X1 for 2011 plus 1.4 multiplied the value of X2 in 2011, and so on. And then we get a total Z-score. So again, we can just start it quite easily by using our normal formulas. So again, we use equal to, open up the bracket, and it's current assets minus current liabilities, which is your working capital, divided by your total assets. So current assets minus current liabilities, close the bracket, divided by total assets. Enter. The second one is retained earnings over total assets. So again, retained earnings divided by total assets. The third variable is earnings before interest and tax, or EBIT, divided by total assets. So again, let's see, we have that in E11, divided by total assets. We then have market value of equity divided by total liabilities, and market value of equity divided by total liabilities. And then finally, we have sales divided by total assets. So we have sales, and we divide it by total assets. So that gives us all of the information that we need for 2011. Again, I'm just going to highlight all 5, go to the bottom right, and essentially just drag it to the right. So what we have now is we've essentially calculated these ratios for each particular year. So in order to get the Z-score, what we need to do is we need to multiply each coefficient by the value of that year and then add that coefficient multiplied by that value and so on. So you can do it either manually by taking equal to coefficient multiplied by value plus coefficient multiplied by value, but that's actually quite the long way. So I'm just going to press escape and show you a quicker way to do it. So a quick way to do it is to use the sum product function in Excel. So sum product, and you open up the bracket and you say that you want to multiply these coefficients comma by these values, and you just close the bracket, press enter, and it does it for you automatically. Now what you want to do is, in order to be able to, for you to be able to drag it to the right, you know that Excel will essentially drag all the cells to the right, all the reference cells. So what you want to do is you want to lock the coefficient cells. So in order to do that, I'm going to go D15 to D19. I'm going to press F4, or I'm going to be using the dollar sign. So again, I'm going to use the dollar signs just to around before the D and before 19 in this case. Press enter, and now it's locked. So now that I drag it to the right, it's going to be automatically calculated for me. So for example, if I go here, I can see that it's used the coefficient still at the absolute area, and then we have the values which have moved since we've dragged it to the right. Now what this gives us is a total z-score. Now the Altman model works by looking at the z-score and saying that if it's below a certain value, then it's safe, if it's above a certain value, and so on. So here on row 21, we can actually see the prediction here. It says safe zone. If you look at the formula that I created, it basically says that if the value is above 2.99, it's safe. So meaning that it's probably not going to go bankrupt. If it's, on the other hand, below 1.81, it's in the distress zone, so it means that it's probably in some form of financial problems. And then at the very end, it just means that if it's neither of these, or in effect in between these two values, it's in the gray zone. So in this case, we can see that H&M is in the safe zone. We can also see on row 22 a function that we can use to actually calculate the probability of default according to the Altman model. So to do this, what I've taken here is an equal to norms dist within brackets 1 minus total z-score. And that converts that z-score into a percentage probability. So again, this z-score model I think was developed back in 1968, but it's still incredibly widely used. But again, what you need to remember is that this original one that Altman created was technically only made for manufacturing firms in the US. Now, what you want to do usually is that if you don't have a manufacturing firm, so you want to use the modified Altman model, which starts down here. And effectively, all it is, it's exactly the same ratios, except it drops the fifth one, because the fifth one is sales divided by total assets, and that ratio is very, very depending on the industry, so you can't necessarily use it use the same, I guess, ratio as for manufacturing firms. So that's why we drop it, and you can see that the coefficients have changed. Again, this has been pre-filled for you because essentially I'm just referencing whatever we already calculated up here, and you can see again to get the total z-score here is just a sum product function as well. And that effectively is the Altman model. It's not too complex, and because it's not so complex, it's very easy to understand, and that's why it's very widely used. There are probably models out there that are, I would say, more accurate, but because they're not simple to understand by just looking at, I guess, 5 different variables and 5 coefficients, it's much harder to gain acceptance. So even though it's a model from 1968, it's still widely used to this day. Now, the last model that we'll be looking at today is the Beneish M-score. Now, the Beneish M-score is essentially a model that's used to detect financial manipulation, so accounting manipulation. Technically, it's kind of related to what we did last week, but usually it's done as part of a risk analysis, just to use a quantitative model to estimate the probability of any kind of accounting manipulation happening. So the Beneish M-score model, you can kind of see it down at the very bottom here. And again, you see that I have Benich score, M-score inputs. On row 34 it starts, and again what I've done is I've looked at all the input variables. So in this case we have accounts receivable, total current assets, and so on, and I've referenced them back from the financial statements, and you can see exactly how I did it. Now this model is a bit complicated, so that's why it's probably going to be a few tries for you before you get it right, because what you'll see here is it uses 8 different index ratios, which is basically that ratios that compare from year to year. And they're quite, I guess I should say, complex. So for example, for days receivable index, here on the right, I've actually written out the exact kind of formula that you would actually use. Now you'll note that I've used these kind of subscript T, and then you have T minus 1. Now T just means that it's in the same year. So if we wanted to calculate days receivables index for 2012, I would use the 2012 accounts notes receivable when it says T, and if it says T minus 1, I would use the 2011 value. And again, it works very similar to the Altman model in the sense that each ratio that you calculate is then going to be multiplied by a coefficient, but instead of a z-score, you're going to get an m-score. Another difference about this model is that it also has an intercept or a constant, so that means that in addition to multiplying the coefficient by the value for each and every variable, you then at the end also add this intercept to get the total m-score. And again, you can see this in my formula. You see D60, which is the intercept, plus the sum of the products of coefficients and the values of 2012. So again, I should say it's a bit complicated in the sense that there's a bunch of T minus 1s and so on. There's a lot of brackets here, so be careful when you add and remove brackets. So for days receivables index, we're essentially just comparing the days receivable this year to the one last year. So in order to use this one, we use equal, we open up a bracket, we take accounts and notes receivable this year, and divided by revenues this year. Close the bracket, then divide that by, open up bracket, accounts and notes receivables last year divided by revenues last year. Close bracket, enter, and you get 0.86. Now the gross margin index is essentially just calculating the gross margin last year and comparing it to this year. So I guess in this case you see it's gross profit T minus 1 divided by revenue T minus 1. So it's first last year and then we're going to compare it to this year's. So in this case we're going to take equal to, open up a bracket, find gross profit for last year divided by revenue for last year. Close the bracket and divide that sum by, open up the bracket, again similarly gross profit this year divided by revenue this year. Close the bracket, press enter. Now the third variable is asset quality index, and here it's a very long formula. As you see, it's within brackets, 1 minus, open up another bracket, then you add a few different assets and so on, and you divide it by total assets. So what we're going to be doing is again equal to, open up a bracket, 1 minus, open up another bracket, current assets this year plus property, plant, and equipment this year plus long-term investments this year. Close that bracket and divide that by total assets for this year and close another bracket there. And then you divide that whole sum by similarly but for last year. So again, open up a bracket, 1 minus, open up another bracket, current assets plus property, plant, and equipment plus long-term investments, close the bracket, divided by total assets last year, and then close the final bracket, press enter, and you get 1.4. Now sales growth index, it's an easy one to calculate, and you essentially just compare this year's revenue to last year's revenue. So it's equal to this year's revenue divided by last year's revenue. Then we have the depreciation index, and that's comparing, I guess, the depreciation rates last year to the one this year. So in order to calculate this one, we take equal to, we open up a bracket, we find the depreciation last year, we then divide it by, open up a bracket, and take the depreciation from last year and add it to property, plant, and equipment net from last year to get the pre-depreciation, I guess, amount for PP&E. Then you close that bracket, and then close another bracket, and then divide that sum by similarly, I guess, the similar formula, but for this year. So again, open up the bracket, take the depreciation expense, divided by, open up the bracket, depreciation expense plus PP&E, and then close two brackets at the end. Press enter and you get 0.97. Now then you have SG&A expense index. SG&A is selling, general, and admin expenses. So what you want to do is you want to look at your central, I guess, SG&A to your revenue for this year and compare it to your SG&A to revenue last year. So in order to calculate this ratio, we take equal to, open up a bracket, find our SG&A line item for this year, divided by our revenue for this year, close the bracket, and divide that by the same formula for last year. So SG&A divided by revenue, close the bracket, enter. We then have the leverage index, which again has a few different brackets here. So we can see it's current liabilities plus long-term debt divided by total assets for this year and comparing it to that exact same ratio but for last year. So again, we open up the equal sign, then open up two brackets, take current liabilities plus long-term debt for this year. So current liabilities plus long-term debt, which is technically 0 for this year, close the bracket, divided by total assets, close another bracket, and then divided by the same formula for last year. So we need to start with two brackets, current liabilities plus long-term debt, close the bracket, and you divide it by total assets. And then finally close the final bracket. Press enter and you get 0.95. The last ratio is just looking at your total accruals, and your total accruals are essentially just your income from operations minus your cash from operating activities, and you divide that by total assets to get the ratio of total accruals to total assets. So again, equal to, open up the bracket, income from operations minus cash from operating activities, close the bracket, and divide it by total assets. And we get negative 0.03. And then we get a total M-score of negative 2.5. Again, I'm just going to highlight all my values here, drag them to the right, and it's going to be calculating everything for me. Now the M-score works on slightly different cutoffs. So you can see here we have total M-score and how it's calculated. So it's essentially just taking the coefficients, multiplying it by the value for each year, and then at the end it's adding on this intercept. Now the decision rule for this model is if the M-score is below 1.78, then it's low risk. If it's above 1.78, then it's high risk. Then we look at the probability of manipulation, which is essentially just taking a norms list function and applying it to the M-score, which is a lot easier to interpret, which just means that based on these ratios, the probability that H&M manipulated their accounts back in 2012 is about 0.62%. Again, when we're looking at companies like H&M, you're going to find very low probabilities of manipulation, and you're also going to find very low, I guess, probabilities of default or bankruptcy according to the Altman model. But again, if your project company is not as, I guess, financially solid as H&M, you'll probably find higher levels of probabilities. And that's essentially it for this week's homework.